The CEO of ARK Invest, Cathie Wood, is a well-known supporter of disruptive technology and has expressed her opinion that legacy automakers are facing difficulties in public. In summary, she believes that Tesla's stock might rise to unimaginable heights and that Ford, GM, and other legacy manufacturers are facing an existential danger. We concur, believing Elon Musk to be the real-life Tony Stark. Click the like and subscribe buttons if you enjoy watching this kind of content. Investment manager Cathie Wood told Barron's that managing for GM and Ford over the next 5 to 10 years will be very difficult. Renowned money manager Wood, who is highly appreciated in the market and bullish on Tesla, has issued an unexpected forecast for Ford and GM. She thinks that over the next 5 to 10 years, it will be very difficult for these companies to exist in their current shape. Cathie's conclusion is that these businesses will either combine with another business or completely fail. Wood projects that Tesla's stock will hit $1,000 by 2025 and that the company could take a sizable chunk of the overall auto market in the next 5 years if its autonomous vehicle efforts are successful. GM, on the other hand, is seen favorably by Morningstar analyst David Winston, who believes that the stock is worth $68. He stated last month, General Motors vehicles are of the best quality and design in decades. A competitive lineup in all segments, combined with a much smaller cost base, suggests to us that GM is starting to realize the scale to match its size. Accompanied by famed stock picker Cathie Wood, ARK Investment Management has taken an unexpected step by buying 158,000 shares of General Motors on behalf of its autonomous technology and robotics ARKQ fund. Given that Wood had previously criticized legacy automakers, this represents a substantial change in her position. A report detailing the firm's recent trades from the previous month included information on the transaction. The CEO and creator of ARK Invest disclosed in an exclusive interview with Yahoo Finance that her team recently met with Mary Barra, the CEO of General Motors, to talk about the company's electric vehicle plans. She added that ARK was thinking about making an investment in GM and was keeping an open mind about it. In an interview with Yahoo Finance's Julie Hyman, Wood underlined the need of accepting achievement and keeping an open mind. She clarified that ARK Invest is still doing research on General Motors and is considering making an investment in the business. Wood voiced her admiration for Mary Barra's transformation of GM and her emphasis on cruise automation. Wood attacked Ford and GM's rallies in January when their stocks had risen on the announcement of their plans to sell electric vehicles. He said that the percentage of sales that would come from electric cars would be insufficient. In an earlier interview with Barron's, Wood even made the bold prediction that Ford and GM may go for bankruptcy because she didn't think they had the right genes to be successful in the electric vehicle market. A Tesla supporter named Cathie Wood claims that the company's brand won't be harmed by its recent price cuts. Rather, it might make it difficult for other automakers to overtake. The founder of ARK Invest said in a recent interview with Yahoo Finance Live that Tesla's cost leadership and battery technology would make it challenging for conventional automakers to match its price reductions. Tesla remains the largest holding in Wood's ARK Innovation ETF, ARKK. Cathie Wood claims that while Tesla's latest price reductions won't hurt the brand, they might make it more difficult for rival automakers to catch up. Wood claimed in an interview with Yahoo Finance Live that Tesla's cost superiority in battery technology is the reason for the price reductions. She also thinks that in order for automakers to stay profitable while keeping up with Tesla's price reductions, they must adopt this battery technology. Because of economies of scale, Tesla will continue to reduce prices while maintaining higher gross margins. Economies of scale have multiple benefits for Tesla. First, by spreading its fixed costs, such as marketing, R&D, and overhead, over a greater number of units, Tesla can lower the cost per unit as it produces more electric cars. This implies that the company's profit margins grow and it gets more cost efficient as it raises the amount of its output. Second, higher manufacturing numbers may allow Tesla to bargain more successfully with suppliers of parts, raw materials, and components, resulting in lower unit prices. Third, economies of scale may provide Tesla a commercial edge over rivals. The corporation may gain market share by lowering its prices as it manufactures more electric vehicles and drawing in more customers. In addition, as Tesla ramps up production, it will be able to. In contrast, Ford and GM only produce a small number of electric cars. Their ability to benefit from economies of scale will be diminished. According to Cathie Wood, economies of scale can help Tesla lower expenses, boost productivity, and obtain a competitive edge, all of which can eventually result in larger earnings and steady growth. Tesla recently lowered the price of the Model 3 Performance variation by $9,000 and the Model 3 base version by $3,000, respectively. The Performance variant now costs $56,990, while the variant Y long range was dropped in price by $13,000 to $52,990. Ford responded by lowering prices to more effectively compete with Tesla, while GM CFO Paul Jacobson has no intentions to lower EV prices. As Elon Musk indicated in the company's most recent earnings call, Tesla's price reductions have raised demand and boosted market share. On the other hand, not all Wall Street professionals have the same optimistic view of Tesla that Wood does. They think that in addition to having a negative impact on profit margins, the price reductions may have a long-term negative impact on the company's brand. John Murphy, an analyst at Bank of America, claims that given Elon Musk's claim that demand exceeds supply on the fourth quarter results call, cutting prices would be foolish. In the short run, you would not be gaining any further extra volume. Instead, you would be chipping away at your profitability. The CEO of ARK Invest and a Tesla bull, Cathie Wood, has revealed the price at which her investment company will sell its Tesla shares. Wood said on Wednesday at the Morningstar Investment Conference that ARK would begin selling its shares if Tesla's stock price reached $1,000 within the next year. Based on a Monte Carlo analysis, ARK set this price target in March, which represents the company's base case for the price of Tesla's stock in 2025. ARK believed that as Tesla built more gigafactories, its product range would grow and its manufacturing capabilities would improve, which is why it backed the price objective. As everyone is aware, Tesla recently declared that a new gigafactory would be built in Nuevo Leon, Mexico. The Nuevo Leon governor has stated that Tesla might start producing its first vehicles in Mexico the following year. The company that makes electric vehicles is going to get the last set of permissions needed to build a factory close to the border between the United States and Mexico. Governor Samuel Garcia said in an interview that Tesla is awaiting the necessary permissions and would be able to start building in March. If all goes according to plan, Tesla may start producing its first vehicles in Mexico the following year. The governor stated that he expected the first cars to be available by 2024 and that the final licenses for the Nuevo Leon factory development were almost ready to be received. Elon Musk made the announcement last week about his investment in Mexico, saying that the next gigafactory will be situated there with the intention of producing a next-generation car. With a $5 billion investment, the factory is anticipated to be the largest electric vehicle production facility in the world. Regarding the production schedule, Tesla has not yet provided a response. #recap. Wood argues that traditional automakers' reluctance to adopt new technologies is a major contributing factor to their current state of difficulties. For instance, they have remained focused on gas-powered vehicles and have been reluctant to invest in EVs. They are so lagging behind businesses like Tesla, who have made significant investments in EV technology and are able to manufacture excellent, reasonably priced electric vehicles. Wood thinks the fact that new companies in the business are posing a greater threat to established manufacturers is another factor contributing to their problems. Focused on producing electric vehicles, Tesla, Rivian, and Lucid Motors have all been able to draw substantial funding. On the other hand, conventional automakers are finding it more difficult to draw in investors, which has caused their market share to decline. Lastly, Wood thinks that the legacy automakers are up against a lot of regulatory obstacles. Stricter emissions laws are beginning to be implemented by governments worldwide, which will make it more challenging for automakers to continue producing gas powered vehicles. Regulators are also urging more funding for electric vehicles, EVs, at the same time, which will put additional pressure on established automakers that have been sluggish to adapt. All things considered, even though legacy automakers have controlled the auto industry for more than a century, Cathie Wood thinks they are in grave danger of going extinct. Many of them are going to fail if they can't swiftly adjust to new regulations and technology, which will present Tesla with an opportunity to hit a $1,000 pricing objective.